CNBC conducted a survey among 20 U.S. strategists to get their sense on how they're preparing for the election risk and the impact it can have, the election outcome, that is, on the markets at end of 2020. And here are the survey results. And remember, this was an email survey, and strategists included essentially wealth managers, buy-side participants, as well as sell-side participants. So this was a key finding from the survey. 14 out of 20 strategists expect a Biden victory, which is pretty much in tandem with what we've seen in the national polls, the latest national polls out in the U.S., suggesting a leaning towards a Biden win come November 2020. Flip over and take a look at some of the other findings from the survey. 10 out of 20 strategists believe that the S&P 500 would fall post the election risk. And they tied it in with a Biden victory because they expect, of course, Biden's tax policies to not be that favorable for market sentiment. Over there, most analysts believe that a 5 to 10% fall could be in the works, depending on whether the Democrats are able to take over the Senate. If they do manage to do that, then that would pave the way for policy implementation on the tax reform front, something that Biden has been very vocal about in his speeches in the DNC gone by. And of course, that would lead the way for Biden to implement his differential tax reform that he's been talking about for a while. As far as a Trump victory is concerned, again, most analysts do not expect too much upside potential from here. Analysts did say that a 5% potential rally could be in the works if Trump were to take over office, but the markets have moved so much already. A 60% return coming in for the NASDAQ from mid-March lows, 45% done for the S&P 500, pretty much pricing in the economic recovery in 2021 and 2022. So the upside potential seems to be capped in the event of a win from either party or either candidate. What was interesting that actually surprised me from the survey findings was the fact that a lot of analysts are still not too worried about a contested outcome just as yet, and something that's not priced into the markets. Most analysts are working with the assumption that if indeed that were to be the eventuality, then the downside risk for the market could be between 5 to 10% if they believe and the market perceives that there is going to be a resolution in sight. If they do not think there's going to be a resolution in sight, which essentially means that there could be a disorderly outcome where it's a close call between Trump and Biden, and that would lead to a vote recount and perhaps a Supreme Court intervention, then that could just delay results, and that could just add to the uncertainty in the markets, paving the way for a more significant sell-off. 10% plus could be in the works.